Today, we will talk about goodwill accounting. Goodwill is an intangible asset associated with the purchase of one company by another. It represents the value that gives the acquiring company a competitive advantage. Specifically, it is the portion of the purchase price that is higher than the sum of the net fair value of all of the assets purchased and the liabilities assumed. The value of a company's name, brand reputation, loyal customer base, solid customer service, good employee relations, and proprietary technology represent aspects of goodwill. The value of goodwill typically arises in an acquisition of a company. It is recorded as an intangible asset on the acquiring company's balance sheet. Under generally accepted accounting principles and the International Financial Reporting Standards, IFRS, companies are required to evaluate the value of goodwill on their financial statements at least once a year and record any impairments. The process for calculating goodwill involves taking the purchase price of a company and subtracting the net fair market value of identifiable assets and liabilities. There are competing approaches among accountants to calculating goodwill. Goodwill involves factoring in estimates of future cash flows and other considerations that are not known at the time of the acquisition, leading to differences in calculations for reported assets or net income between different companies. Impairment of an asset occurs when the market value of the asset drops below historical cost. If a company assesses that acquired net assets fall below the book value or if the amount of goodwill was overstated, then the company must impair or do a write-down on the value of the asset on the balance sheet. The impairment results in a decrease in the goodwill account on the balance sheet and a loss on the income statement. Companies assess whether an impairment exists by performing an impairment test on an intangible asset. The two commonly used methods for testing impairments are the income approach and the market approach. The Financial Accounting Standards Board was considering a change to how goodwill impairment is calculated, but this method reduces the value of goodwill annually over a number of years. Goodwill is not the same as other intangible assets and has an indefinite life, while other intangibles have a definite useful life. Goodwill is difficult to price, and negative goodwill can occur when an acquirer purchases a company for less than its fair market value. This usually occurs when the target company cannot or will not negotiate a fair price for its acquisition. Goodwill is difficult to price, and there is the risk that a previously successful company could face insolvency. If this happens, investors deduct goodwill from their determinations of residual equity. Additionally, negative goodwill can occur in distressed sales and is recorded as income on the acquirer's income statement. A real-life example of goodwill is the T-Mobile and Sprint merger, where the difference between the fair value of the assets and liabilities contributed to the recognition of goodwill. Goodwill is included on a company's balance sheet and is based on the premium paid for the acquisition. Evaluating goodwill is important for investors as it can affect a company's balance sheet and financial statements. It is challenging for investors to determine whether the goodwill a company claims to hold is justified, and this can impact investment decisions. If a company purchases another for a premium above the fair market value of its assets, the difference contributes to the recognition of goodwill on the balance sheet. The value of goodwill reflects the potential value and competitive advantage gained through the acquisition. Goodwill represents a value that may be obtained by one company when it purchases another, and it is reflected as an intangible asset on the balance sheet. Companies are required to review the value of goodwill on their financial statements at least once a year and record any impairments. Goodwill has an indefinite life, and while impairment tests can be run to determine if its value has changed, it is not the same as other intangible assets. Here are 4 key takeaways. 1. Goodwill is an intangible asset associated with the purchase of one company by another. 2. Goodwill is calculated by taking the purchase price of a company and subtracting the difference between the fair market value of the assets and liabilities. 3. Companies are required to review the value of goodwill on their financial statements at least once a year and record any impairments. For, goodwill has an indefinite life, while most other intangible assets have a finite useful life. Hope this would help. Thanks for watching.